Accounting for reconstruction of companies. Reconstruction of companies. Now, a company's financial position may be very weak. Okay. They could not survive for a long period. Supposed to be liquidated or wind up the company. So they may have a small try. Can we at least try to save the companies rather than being it closed? For that, this internal reconstruction process will be useful. Is that clear? Their balance sheet is not proper. See, in a company, assets may be 1000, capital 500, liability 1000, accumulated profit and loss 500. Then the balance sheet total being 1000. If we close the company, definitely what happens? Capital, the owner will get nothing. So we'll sell this asset for 1000. We assume we could realize the same value what we have in the books. Out of that amount, first you have to make the payment to the external liability, which is the liability. So the 1000 is meant for the 1000 of the liabilities. We don't have any further money shared to the owners. They will not get anything. Now owner will be totally demotivated. They will not run the business. They will simply say that go on close. But if the business get closed, the assets we have book value being 1000 may realize around 600 or 700. In case of an emergency, if you are selling your product, that product will fetch you very, very lesser money. So in that case, what happens? The lender will get less than what they lend actually. So the lender may now go to the owner, do some justifiable manner, take action. Up to this point is good. The business could be restarted. We'll support somehow so that you can restart. So before we plan to wind up, can we have any opportunities to restart? In that case, these two contributors are asked to sacrifice their contribution so that this loss can be wiped off completely. So the owners will say, sir, we have accumulated loss of rupees 500. We now need to remove this 500 rupees. If there is any profit, will be added to the owner's fund only. Similarly, if there is a loss, should be subtracted from the owner only. If I subtract this entire 500 from the owner's fund, it becomes zero. They are not interested hereafter to run the business. So they will go for the negotiation with the lenders. Sir, huge loss. Definitely it's not possible. You do one thing. Out of the 500 rupees loss, some loss you just to take it or you forego. Balance I will take care. So such a way, this 500 rupees, this lender say, okay, I will take up around 200 rupees. Leftover thing, you can adjust your account. Such a way, now we prepare a new balance sheet. Asset remains 1000 rupees. Capital, originally 500 rupees because of adjusting the loss, accumulated huge loss in the previous year. 300 rupees is subtracted. Now we have only 200 rupees. Similarly, liabilities, we had originally 1000 rupees. Now we forego, we ask them to forego some of their own liability, which is 200 rupees. Now 800 rupees. If I tally, then the balance sheet gets tallied. See, now you compare the two balance sheets. This balance sheet seems to be more solid and more worth also. This balance sheet has lots of accumulated losses. Actually makes me less interested to run this show. Such a way we do slight reconstruction before we plan to go for winding up. So we try to at least do a justifiable practice to make it survive better. That process is called internal reconstruction. All the accumulated losses are grouped. Those losses will be now asked to take some contributors. So you take some extent. Okay. Now, first of all, all the losses are grouped and all the various contributors fund also be grouped. The various contributors fund. Owner says, I will forego 200 rupees. Lender say, I will forego 100 rupees. All the lenders, what they forego will be kept in a new account called internal reconstruction capital reduction account. Capital reduction account. That will be a profit link. We don't operate and get the profit, but we ask the contributors to forego. So we have to pay you 1,000 rupees. Now kindly accept only 700 rupees. We cannot pay the 300 rupees. Such a way we are reducing the liability payable to somebody else by negotiating. Okay, the lender also says, okay, you can just pay 700 rupees. You can forego 300 rupees. The amount we now ask to be discounted from the creditors is kept in a new account called capital reconstruction account, reorganization account, or reduction account, capital reduction account. That's a profit link. And all these losses will be adjusted there. Usually losses are going to be debited to the P&L account. Here we don't debit to the P&L account. We are going to debit that to the capital reduction account. This process is called internal reconstruction. Procedure of reduction of share capital. Reduction of unpaid capital is other things. Cancellation of lost paid up capital. What I have given example in this case is all about cancellation of lost paid up capital. So this amount is lost, we adjusted this loss in the capital account. Unpaid capital, 10 rupees fully paid up capital, or means face value. Okay, but called up and paid up value is only 7 rupees. The difference between these two is the unpaid up money. We now hereafter restate partly paid up capital into fully paid up capital. How? Without collecting the money further, we convert this face value being 7 and the paid up value is also 7. Is that okay? This partly paid up capital becomes fully paid up. This is called conversion of partly paid up into fully paid up without collecting any further money. This is nothing but unpaid capital is reduced. Sometimes there may be excess capital can be paid off like buyback. So we might have issued shares and collected 100 crores. Later on we came to know we are in need of only 60 or 70 lakhs, 70 crores for the business. Almost 20 to 30 crores we collected excess, no more required, can be refunded. So how can we refund? We can go for buyback plans also. So such a way we can refund. So that the money can be used effectively. Where the business is in need of 70 crores only, but this business has 100 crores. This is need, but this is they have. Okay. Anyhow, this business gives you only 7 crores as your revenue. Currently, what happens? Your revenue being 7 crores. In your balance sheet, you show the capital being 100 crores. Every year, by preparing the P&L account, you find out the profit being 7 crores. Otherwise, 7% you are earning. On scrutiny, you came to know out of the 100 crore rupees, almost 30 crore rupees ideally sitting in the savings bank account, like current account, without any interest, no revenue. Not required. Fund remains more than what's in need, remains unutilized, ideally. Even though if I repay the 30 crores, that 70 crores is more than enough to run the business. For that 70 crores, still I am getting the same 7 crores. Now, because of this one, so I have done the buyback shares. Because of doing so, now I am getting 7 crores for 70 crores of investment, otherwise it is 10% return. So 7% return of the business is now increased to 10% return by doing this one. So these are the modifications are carried over for promoting the betterment of the company or improving the financial performance of the companies. One is repay the excess capital. Another one is unpaid capital, if any, can be removed by reducing the face value. Another one is lost capital could be removed totally by asking various contributors to forego their own liability. Is that okay? Studying all these things will fall under internal reconstruction, otherwise reconstruction of the companies. Now, before that, we have to better understand some aspects. Alteration of share capital. You are in need of alteration of share capital very often. This alteration of share capital always linked with what? Internal reconstruction. For example, here 500 rupees, this 500 represents 50 10 rupees shares. 50 10 rupees shares. Now we are converting every 10 rupees share into 2 rupees shares, like. So 2 into 50. Earlier they had 500 rupees, now 50 into 2 or 4 rupees shares. We can have 4 rupees shares. 50 into 4 is equal to 200. So if you have 10 rupees share, surrender the 10 rupees to the company and get back 4 rupees share. Sir, what about the remaining six are last, that's all. Okay, you give your 100 rupees note and get 20 rupees currency like. So that process is separate, no? Those things are called alteration. So alteration of share capital or alteration of stocks into share and vice versa, everything is forming part of the internal reconstruction. So these are the adjustments. Internal reconstruction, the broader view, where these things are small part. Right. Alteration of share capital, very simple. All the share capitals are appearing in the balance sheets, which side? In the liability side, credit side. Liability side means credit side. If anything is converted from one form to the other form, the existing form should be first cancelled. The existing form is usually credit balance. To cancel that, you have to debit that first and create the new one by crediting that fresh. So, for example, 100 rupees share is converted into 10 rupees shares. So, you are giving 100 rupees currency and getting 10 rupees change like, okay, 100 rupees share is given and 10 rupees shares are converted. Share appears in the balance sheet's credit side. To cancel that, it should be debited. Which one should be debited? This one should be debited. What capital rises fresh, that should be credited. So 100 rupees share is cancelled. So I am debiting that. New share being 10 rupees equity share capital emerges instead of that. So this is cancelled and this is arising. Clear? So a bigger denomination share converted into smaller denomination share is named as stock split. Even 1 10 rupee shares can be converted into 10 1 rupee shares. Or sometimes 10 rupee share can be converted into 5 2 rupee shares. All these things are possible. Okay, because if the share is 10,000 rupees per share, okay, in the market, 10 rupee shares or 100 rupee share traded at rupees 10,000 in the market. Okay, one share. This is the face value. This is the market value. Is that okay? If you go and see the price of a share in the stock market, it may not be always equal to the face value. It may be usually higher, 3 times, 4 times, and sometimes it may be 10 times higher. Here, 100 rupee shares traded at rupees 10,000. If you want to invest, if you want to start your investment in the stock market, come on, tell me. Okay, will you purchase a share? So, there may be some shares available in the market at rupees 50 rupees, 100 rupees, like, would you like to purchase this share or this share? Because you are capable of investing 5,000 rupees or 10,000 rupees or 1,000 rupees. There will be more buyers if the rate is very cheaper. If the share price is 50,000, one share 50,000 rupees, keep it with yourself. I don't want to purchase. Of shares will have plenty of buyers. If more buyers are there, what happens? What happens? Demand is higher and naturally it increases the price also. Okay, increasing demand, increasing price. The same happens. So this company wants to raise their image value in the market. They now split this. How? 100 into 1 rupee shares. 1 rupee shares split. The next date market value per 1 rupee share becomes 100. Isn't it? So you are holding 100 rupee share. You now surrender that to the company and get 101 rupee share. Okay. So one share earlier 10,000 rupees. Now you get 100 share also be 10,000 rupees. For one share 10,000 means per share 10,000 rupees. Now 10,000 for 100 share means one share is 100. Automatically most of the people desires to purchase this share, but because of the high price reluctant to purchase, now very happy to purchase this, right? So it's now only 100 rupees. I am willing to purchase this more hereafter, right? So automatically what happens? More demand pushes the price from 100 to 105, 110, 115 also. Naturally, without any extra work or financial performance done by the company, company's image is inflated by 10 to 15%. Okay, that's how Elon Musk, Mukesh Ambani, Adani, always their name comes in the top richest peoples. Because the moment they do so, if they hold probably 10,000 crores worth of shares, 10,000 crores. Just doing this way, next second 10 to 15% will be increasing. Then the next day, 11,500 crores. You see the newspaper, immediately you will get that. Within 1 year, they become multi-millionaire, earned 1,500 crore rupees. Have they worked? No. They have done slight gimmicks. Okay. So I purchased a share for rupees 250 very long back. I was very passionate, so I purchased. When I entered into the stock market almost 20 years ago, it was storming share for me. So it was matter of 250 rupees. Within 3 to 4 days, it went to 320 rupees. I sold. I made a profit of 70 rupees for 250. It means roughly 70 means, okay, 70 for 250. 28% is my profit. 30%, closer to 30% profit in a matter of 3 to 4 days. Then I thought, if the price again comes back to 280 or 290, I can purchase. But the moment I sell, no, thereafter the price has not gone down at all. Sometimes later, I just started watching that same shares price and shocked. It was around 40,000 rupees per share. Oh my God. That happens. That happens. Currently, I think they have converted this into probably 1 rupee share or something. I'm not aware about it. Let's see. Okay. Lots of things are happening. Okay. Now, I thought this company will go off in the market. It will not be picked up. Suddenly, what happened? Again, it got so famous in the market. Okay, how many of you heard about this company? How many of you heard about? So, what's the value? 5,656. I told you it is around 40,000 rupees, right? Yeah. What's the face value? Originally, it was 10 rupee share, then it split it into 10 1 rupee share. 40,000 become 4,000, like immediately again, people started purchasing and it went up to 6,000, closer to 6,000. I purchased it for 250. If I keep the share without selling today, after 20 years, it could be 60 times, not 60,000 rupees per share. You understand? If I have 2 share, I may be lakpati. Huh? Only 2 share, 250, 500 rupees, the peak time. This peak time rate also due to splitting. Okay, 1 share 40,000 rupees definitely will not be sellable. So then immediately split it. Let's see, their corporate actions. Here is corporate actions. Split. When did it happen? Let's see. It happened in 24th August 2020. 10 is the old face value and converted into 1 new share face value, which is 1 rupee. Splitting. By this time, it was around 40,000 rupees. Then immediately they shifted to 1 rupee share. 40,000 divided by 10 share. Per share's market rate is 4,000. Then it shooted up to 6,000. The time when I sold for 320 or 330, I thought this company will not sustain. Somehow they will go for closure later. But again, the Royal Enfield got picked up. Was a product of Eicher. Royal Enfield. Okay, during my days, Royal Enfield was old-fashioned one. So in the traditional movie, if you see, they will come in the bullet with the sound. In my days, no, we started playing with the Yamaha RX100. RX100. That was the famous bike by the time. And I had YBX, Yamaha, the next model, where it was 4-stroke model. So I started with the Yamaha 4 YBX. That was the period where we enjoyed those bikes. Sometimes later, again, Royal Enfield got picked up, the share price got picked up. Okay. Now, most of the students at your age will be the dream bike of this one, right? Royal Enfield. My cousin purchased Royal Enfield. What are you doing with the Royal Enfield? Now and then in Sundays, no, we have the team to go for outing of 200 kilometers in 3. It's a club, Royal Enfield club. So all the people now enjoying that one. So unnecessarily they are inflating the share price now because of this reason. Anyhow, these things are happening. This is also one of the good example for the internal reconstruction. Stock split. Not only stock split, in a reverse case also may happen, which is consolidation. 10 rupees equity share, every equity share being 10 rupees face value. You combine 10 rupees equity shares and make the face value being 100 rupees share. This is also possible. When if the share price is so low, 10 rupees face value, in the market it seems to be only 2 rupees because of the huge loss, bad image over the company. Okay, then what they do, 10 into 10, 100 rupees share. That's how 10 shares are clubbed together or consolidated. Then the market price will be at least a reasonable number, 20. Also be possible. So that is called consolidation. This happened in Rama Newspaper and Print. I don't know whether this company still exists or not. Okay, Rama Sri Rama Newsprint. This underwent internal reconstruction. Sri Rama, okay. But it was Rama Paper Mills, paper and newsprint. Here the two companies are there. I don't know. They might have splitted. I'm not sure what happened then. So as this company had very poor performance, it was out of my portfolio. So it's not in my mind now. Anyway, let's see. Okay, it is around 34 rupees. Okay, what is the face value? 10 rupees face value. Actually, it's a 10 rupees share converted into 100 rupees share. Later, for every 100 rupees share, they issued 10 rupees shares for writing off the loss at 90 rupees. That's how they have done. If there is a loss, give 10 rupees share, get 2 rupees share, you don't get remaining 8 rupees. That will be capital reduction, gain accumulated for setting off or adjusting the accumulated losses happens here. Okay, that's how it also happened. I think Rama Paper Mills, let's see that one. So all these things are again need of the hour. You have to understand the internal reconstruction part. So I am giving some examples here. Okay. Yes. Very slow. 14 rupees 50 paise. I think this will be the correct one. This one is not showing me correct answer. Okay. Let's check in screener. So this will be very fast. Yeah. So what's the book value? Yeah, then it could be Rama Paper Mills only. Very poor company. Already they have written off their own losses once. Now they have to re-written off, do written off again, internal reconstruction. Okay. So the book value per share is minus 27.2. One share if I sell. Okay, every owner is losing 27 rupees. That's what about the logic. Okay, there's no fund at all. Rama Paper Mills. Okay. This underwent for internal reconstruction and all, yet it is not now working properly. It's not worth investment also. Okay, this is not worth investment. So face value being 10. You can check the corporate actions. What are the actions they have underwent? Is there any splits? No splits. No bonus. Yeah, they have given bonus also 1997. This company came for me for analysis in 2007 or 8, I think. So by the time it went for the internal reconstruction. So dividend in 2007 they have given dividend, splits, no splits, board meetings. You can go and see any announcements. Okay, you can go and check. There will be internal reconstruction for this company. Is that clear? So what happens, every 100 rupees share can be converted into 10 rupees share. This is called stock split. The existing share appearing in the credit side means liability side of the balance sheet, credit side. To cancel that, it should be debited. Existing one. The newly converted will be now credited here. So 100 rupees equity share capital debit and 10 rupees equity share capital credit. Consolidation. Summing up. 10 rupees equity share capital is consolidated into 100 rupees equity share capital. So consolidation. So this should be debited, this should be credited. Conversion. Share capital is converted into stock. Stock is a collections of shares. Okay, collections of shares. 10 rupees, 10 equity share capital is converted into 100 rupees equity stock. If you have 10 rupees in your hand or 10 rupees currency in your hand, what happens? You have 10 currencies, 10 rupees currencies. Okay, with the serial number for the currency. Understand? You want to give 22 rupees 30 paise. Will it be possible to give 22 rupees 30 paise out of this amount? You cannot give it. You cannot give it. But what you can do? You can deposit in your bank and then you can do the Google Pay or whatever it may be, UPA, whatever it may be, you can do. The moment it is deposited into the bank, it is only amount, it's not currency with the serial number. It loses its serial number. Only to the extent of 100 rupees is available. That 100 rupees you can use it for any denomination settlement. Right? Clear? That's the logic. So, for the easy transfer, earlier we had the concept called converting the shares into stock. Once it is converted into stock, it's not having the distinguished number. Then you can transfer in any denomination. If you want 2.5 shares, you can give 2.5 shares worth the value stock out of your stock. But you don't have the voting rights because there is no identity. Who is the owner for that? That's the problem. Again, you can surrender the stock and you can get a share also. So this is called conversion. Share can be converted into stock or stock can be converted into stock. In both the way it will be possible. In case conversion of share into stock, this is appearing in the credit side, so it should be debited and it should be credited. And conversion back. Equity stock is converted into share, then it should be debited and it should be credited. Is that clear? Already I told you what is called capital reduction. 10 rupees equity share capital, 10 rupees being the face value, but out of the 10 rupees currently we have collected only 7 rupees. This is called paid up capital. Hereafter it is going to be converted into 7 rupees face value and paid up also 7 rupees. Earlier it is a partly paid up share. After this it becomes fully paid up. Fully paid up. So automatically what happens? This share is debited and new share is credited. So 7 rupees equity share capital debited and new share being, so this is debited, this is credited. So 10 rupees equity share capital account debit, 2 equity share capital, 7 rupees 1 is credited here. And rarely we may have the shares with the variation rights. Variation rights. Okay, 10 rupees preference share capital is converted into 12 rupees, 12% preference shares. Okay, then existing 10 rupees preference share capital is cancelled. To cancel that, it should be debited. And now it becomes 12 rupees, 12% preference share capital that should be credited. For example, preference share capital, 10% to whom we have to pay 1 lakh. Okay, 1 lakh. For the last 3 months, we have not paid even single dividend because the business is not good enough. So as per the commitment, it's our duty to pay 30,000 rupees dividend, right? So for the past 3 years, we have not paid any dividend. And then preference shareholders are demanding, what happens, sir? So poor. I thought I may get decent dividend year after year, but you don't give me dividend also. I'm scared running the business with you. I want to go out of it. Then the business board may decide, the directors may say, sir, we are in poor situation. Now we got back. We will now do better job hereafter. Do one thing for me, one favorable for me. You score out this. Don't ask me the 30,000 rupees. Oh, I'm going to lose that 30. Don't forget about you. Don't worry about the 30,000, sir. Hereafter, I will give 12% preference share capital instead of this. So you are foregoing some of the commitment. I'm offering you hereafter rather than 10%. It's 12%. Earlier, your right being only 10%. Now your right being 12%. So this one is cancelled. This one is now you are getting. This should be debited and this should be credited. This is what about the variation of the share rights. You have the rights to get 10%. Instead of that, now you are getting 12%. Similarly, cumulative preference share can be converted into non-cumulative preference shares or vice versa. Non-cumulative preference share can be converted into cumulative preference shares. Cumulative preference share means if there is any dividend in the past days not paid, they have the rights to get it back together with all the outstanding in the later period. That's what about cumulative. Hope you will be now able to understand cumulative as well as non-cumulative. Clear? This is all about alteration of share capital. Now, there's a small difference between shares and stocks. Very rarely this question also asked in the theory form. Shares may be fully paid or partly paid. Shares can be either fully paid or partly paid up. But in case of stock, it should be fully paid up only. Only the fully paid up shares, you convert that into stock. Partly paid up cannot be converted into stock. And a serial number will be there. That number is missing in stock. So if you have the currency, you have the serial number in that. Once you deposit that, you don't have any serial number for that. Now, shares are always registered. Already told you, as the stock will have, shares will have the number, and who is owner of this also be identified. But in case of stock, we don't have the number. We are not sure who is the owner. Means whoever he bears this, he is being the owner. Okay, if I registered. Okay, so shares are always registered and non-transferable by mere delivery. It cannot be delivered, just a delivery, and you cannot transfer. Shares are often equal nominal value, but here stocks may be divided into any nominal amount, 25 rupees shares, 30 rupees shares, like 30 rupees stock. Okay. Now, shares are issued when companies incorporated. Usually, at the time of incorporation, the shares are issued. After incorporation only, okay, the fully paid up share is converted into stock. Stocks are not issued when the companies are incorporated. At the time of issuing, it's only share. After completing the fully paid up form, then as per the request of the shareholders, it may be converted into stock. Clear? Hope you will be now able to understand the difference between shares and stock. Now, so these are the sets of journal entries you better have the knowledge over. I'll explain directly with question number 1 here, so that you will be able to understand easily all the logics. Before I proceed, I'll give the concept background here. In your balance sheet, you have the asset and loss, capital, liability. What are the things are possible? You gain somehow to make the others sacrifice. I ask the owners to sacrifice some amount. What are the things they sacrifice? Means reduction of capital. It's called capital reduction account. Some lenders will forego. That is also my capital reduction. On selling the asset, sometimes we sell more than its book value, sometimes we sell less than book value. If the balance sheet assets, the assets available in the balance sheet has market value higher than the book value, okay, then it's my gain, credit. Is that okay? So we can gain benefits by asking the capital to forego their liability. Ask the lenders to forego some of their own commitment. All these things are accumulated as my gain, named as capital reduction. And whatever the assets I have, cross-verify with the market rate. If the market rate is higher than the book value, that extra amount is my gain, can be named as my capital reduction credit balances. So we have found out the credit values, means accumulated the profits, can be used for what? Adjusting the losses. When the loss comes here, this one can be adjusted, okay, by debiting to the capital reduction account. So to reduce this, I have to reduce this, write off completely the loss available in the debit side of the balance sheet, means asset side. Currently we are showing the loss in the liability side itself, under the equity itself. So where you are showing the loss in the brackets currently, right? Earlier we showed that in the asset side, okay, as fictitious asset earlier. Anyhow, I have to write down that. Sometimes the value of the asset may be less than the value of the assets available in the books. So that is also loss. That reduces the value of the assets. It's also be considered as my loss, debited to the capital reduction. Sometimes when I go for repaying the liability, I thought 1 lakh rupees. I asked them to forego 10,000 rupees. The lender says, okay, 1 lakh you have to pay. I am willing to set off 10,000 rupees. No problem, right? But the latest 3 months ago, you purchased an item for 30,000 rupees. What about that one? That one is totally missed and messed up in our books. We have not recorded. Only then we realized, oh my God, that one also there now. Okay, I will pay 100 plus 30, 130. Okay, I'm in weak position. Give me a means or discount. Okay, you just take the discount. So even after the discount also, the amount payable to the lender may be higher. So it may sometimes be higher or also. If the payment to the lender seems to be higher than the book value, also be lost. That loss should also be adjusted where? In capital reduction. So all these things are ready. So I have given 3 green items, 3 black items. 3 green items are for the gains. When the capital and liabilities are decreasing, it's a gain named as a CR account, capital reduction. Asset value increases, gain also be considered as capital reductions credit side. And this accumulated capital reduction value, the accumulated profit because of this one, can be used for writing off the losses, existing fictitious asset, and in case the asset value is less than the book value in the market, then you can write up that one also. Similarly, when I thought the liability may be only 1 lakh to be settled, but later on verification, I thought it should be almost 1 lakh 10,000 rupees. I have to pay 10,000 excess. That is also loss. Those losses are again adjusted in the capital reduction account. Let's see. For this capital reduction, the journal entry being, you are reducing the liability. You are reducing the liability. Liability is a debit credit balance. To reduce that, it should be debited. And what do you have to credit? So you have to credit capital reduction. Okay. So liability account to capital reduction. If it happens in a reverse case this way, okay, liability will be credited further and it should be debited to the capital reduction. So capital reduction to liability. Is that okay? And similarly, assets. Sometimes we have the chance to increase the value of the asset. If you are increasing the value of the assets on comparing with the market value, it's a gain. So asset is debited to capital reduction. So here is 4th one. In a reverse case, asset value may go down. In that case, I can simply debit to the P&L account like here capital reduction. So you can interlink the capital reduction is equal to the P&L account like, but should not use the P&L account because P&L account is the profit or loss you are getting due to the business operations. It's not so. It's about compromising with. Now, to write off this accumulated losses, that losses should be credited and capital reduction should be debited. So here is capital reduction to accumulated losses, profit and loss, and whatever it may be. Right. Now, instead of that, if there is any profit already exist, no more that profit is required. So that should also be cancelled or used, can be cancelled or used. So it can be credited. Like there is an accumulated losses should be write up. If there is any accumulated gain, usually not so, but if exist, no more required because the company is almost in the closure mode. So you can use that also. So I'm using it. Right. Finally, okay, asset value increase 100, liability value decrease 100, capital value decrease 200, 400 rupees. Overall loss, asset value decrease as well as loss cancellation. This is around 200, this is around 150, 350. Clear? 50 rupees. We thought the business has huge loss, like assets value lost by 100, 200, liability, so loss is there, so loss is around 150, that should also be now removed. So overall, I'm in need of 350 rupees profit. So we had a meeting with various lender called for foregoing their own commitment. So lender, okay, I'll forego 100 rupees. Owner say, I'll forego 200 rupees. Whatever they forego is my gain. Apart from that, on verification, asset also has good value in the market. So I restated that too with the new market value. So I got 400 rupees gain. But accumulated losses to be written off is only 350. There is a surplus 50 still. What we can do? If there is any surplus, that can be transferable to the capital reserve account, not capital reduction account. From the capital reduction, it becomes capital reserve account. It's not P&L account. Capital reduction reserve account. Or if you find any other assets or losses can be set off, you can use this one also as per the choice. Here, see, if there is any credit balance in capital reduction after all this internal reconstruction, no more required that capital reduction, then the capital reduction is debited credit to the capital reserve account, or if you want to reduce any value of the assets worth, then you can credit there also. Okay. So these are the steps. The capital reduction account sometimes may be named as capital reconstruction account, sometimes named as reorganization account, or sometimes named as reconstruction account. So don't panic by seeing different terms in different books. All the terms are the same. So from this, it is very clear. I will give the summary again in your balance sheet. You can have this one easily. What are they? Assets as well as accumulated losses. Here, capital as well as liability. What happens? What are the possibilities for the gain? Capital reduction is the gain, and liability is also reduction of the liabilities being gain. Okay, I can name this way: reduction being gain. Here, increase being gain. Okay, asset value increases, definitely gain. Okay, now if you want to reduce this, this is a loss. This is the loss. Reduce. And asset value decreases. Okay, sorry. Increase in liability being the loss, decrease in asset being gain. Okay, you can pass journal entry as per the rules we have listed here. Okay, after final verification, if there is any capital reduction amount still pending, can be used for reducing further assets value, or you simply name this being the capital reserve account. Capital reserve has a limited purpose to use. In case of net profit, profit and loss can be used for any purpose because company earned one. Company earned one, the company has the rights to spend for the dividend distribution, or they can use it for the bonus, or they can use for any reserve creation. But when it is being the capital reserve, it has a special profit nature. So it should be used to specific purpose only. So once the capital reduction remains unutilized, rename this to the capital reserve account. Clear? Now, apart from that, I may explain the third part here. Compromise arrangements, etc. In this case, how the journal entry could be. Compromise and arrangement. For example, this one itself a compromise case. Okay. This one itself. It's a good example for the compromise. The preference shareholders demands you have to pay me 10%. Okay. But since the last 3 years, you are not paid any dividend. Come for a compromise, I cannot pay that. Okay. You forego the last 3 years dividend. Instead of that, hereafter I will give you 12%. That's how we'll discussing and finalizing. No, it's called compromising. Similarly, in this case, compromise means one of the creditors to whom we have to pay 100 rupees. Okay, he demands, when will you pay the 100 rupees? Sir, we are not in the position to pay immediately. You do me own favor. Further, you supply me goods without any further cash burn. Sir, already 100 rupees is pending. Leave that pending. I want to run the business hereafter in a good manner. The economic position is also good enough, sir. Kindly give me another 50 rupees worth of stock in credit. Automatically, the creditors increases to 150. Now, ask him 20 rupees waiver. Okay, still you have to pay 120. This is the old one. This is the new one. Okay, 30 rupees is waived. New one. And this adjustment is called, means compromising. Okay, here, old one. Old creditors is cancelled, which is 100. And we asked him to supply further, probably purchases further, another 50. Now to creditors, new one, 120. And the difference between these two is your gain, capital reduction. Okay, 100 rupees is the original value. Instead of that, hereafter the creditors being 120. Okay, apart from the 100, another 50. I'll just purchase the goods, and because of that reason, I have to pay 150. Instead of paying 150, I tell him I'll pay only 120. Oh, he accepts. Okay, I'll pay. You just pay only 120. That's enough. I understand your situation. You did a good business for a very long back, almost more than a decade. You had a relationship, so I'll just help you to support in this occasion. So he says just pay 120. Those amount foregone here is called capital reduction account. Is that clear? Old liability, new liability. Sometimes the new liability being rather than creditors, it may be debenture. They will say, I don't want to keep it being the creditors. Instead of that, give me debentures worth 120. Already you have to pay me 100. I'll supply further another 50 rupees stock. 150, but you give me 120 rupees debentures, that's okay. Balance I can leave. Okay, it's not necessarily the same creditors. It may be preference share or debenture or some other secured loan, like whatever the way they want to settle, we can settle after a small compromise. That may happen. So old liability and new liability. New liability may be debenture or preference share capital, or sometimes give the money immediately. I cannot do the business hereafter with you, but settle, give me 120 rupees. Okay, I'll give 120. So such a way we can give the cash also. Whatever the mode of compromise, no, think over to pass journal entry. The due payable, how the due settled. The difference between these two, the due payable is debit, due settled will be in credit. And the difference between these two is your gain, usually named as capital reduction. Capital reduction. Is that clear? Let's start with first illustration to make you understand. Now, let's move on to the next one. You can better prepare the capital reduction account separately from all this journal entry. Okay, this is like a P&L account. This side, comparing with the book value, is a gain and liability decreases. Also be gain. In a reverse case, asset value decrease will be the loss and liability value increase being the loss. That's how you can adjust in the capital reduction account. Let's start with the first illustration. Apart from that, I have given around 5 different notes. These notes also be incorporated one after one. So these are the points only you have to understand. That's more than enough. Clear? Now, we'll start with the practical problem. Question number 1. Balance sheet of weak company. The company's name itself weak. Okay, to score good mark, you have to be strong in this chapter. Most probably 15 marks question, 16 marks question you can expect from this chapter. Okay, 2 attempts once you will get the illustration from this topic. See, so important. 15th chapter, 14th chapter, then you have to go for the amalgamation chapter. These 2 chapters, if you are mastered, then you will be scoring with 25 marks guarantee. These 2 chapters. Okay, and these 2 chapters only has lengthy illustrations, consuming lots of time. Do lots of practicing this topic so that you can score better mark, right? Now, as it is a weak company, definitely you can cross verify there may be accumulated losses in the balance sheet. Of course, it has almost 500 rupees accumulated losses. What are the things are going to be done here? Non-current asset is written down to 650. Current asset is valued at 250. So non-current assets. Non-current asset is written down to 650. Because of that, we'll get capital reduction rupees 50. Am I right? And current asset is valued at rupees 250. 300 becomes 250 and 50 rupees capital reduction. These 2 are what? Loss only. Already this 500 is loss, should be written off. I am identifying the losses and gains. Okay, always remember, accumulated profits and losses should be written off. That one loss. Asset value decreases there, also loss charged to the capital reduction account. Okay, non-current liabilities is increased by 50 but agreed to forego 100. Just now I told you, compromising. Non-current liabilities. What are the non-current liabilities? We have long-term borrowings. I go and borrow from him further 50. After borrowing further 50, I ask him to forego 100 rupees. That's happening here. Right. So then this non-current liabilities 8% debenture, 300 plus 50, 350 minus 100, 250. Because of this reason, I gain 50 rupees. I gain 50 rupees. Okay. Gain. Given directly. In case of loss, I have given that value in brackets. Okay. So here increase 50 and cancel 100. Increase 50, cancel 100. Increasing 50 is nothing but we may get in money also, cash form also. We are not sure. We'll see that later on. Okay. Current liabilities are agreed to forego 50 rupees. So current liabilities, they forego 50 rupees, then it becomes 150. As they forego 50 rupees, it's my gain. It's my gain. And equity shares of rupees 5 is issued for every 1 share for rupees 10 each. 10 rupees share is converted into 5 rupees equity shares. Naturally, what happens if you have 1 10 rupee share, instead of that, you will now get only 5 rupee shares. Another 5 rupees is now cancelled. That cancel will be the gain for the company. Here, the company has the equity share being only 500. Is that clear? Now, if you tally this, what is the value? 250 plus 150, 400 plus 500, 900 rupees. That's all. We got the answer. That's all. We got the answer. Anyhow, we have to systematically solve to get the mark. You get the answer immediately, no problem. But you need to go systematically to score at least 8 marks. This problem may be 8 marks. To score 8 marks, if you do so, you will not get anything. We will now pass the journal entry one after one. Okay, let's see. These two are going to be the value of asset decrease loss. To reduce the value of the asset value should be credited and the loss is debited to the P&L account rather than P&L account. Here, capital reduction account. So, capital reduction account debit to non-current assets to current assets. This is 50, this is 50, overall 100 rupees. Okay. Second entry being these two are going to be cancelled. Okay. Because of these cancellation, you gain. Gain means CR should be credited. Then non-current liability debit, current liability debit to CR account. CR account. Here 50, here 50, 100 rupees is my gain. Now pass the entry for the equity share capital. 10 rupees equity share capital is cancelled. For that 5 rupees equity share capital is issued. The equity share capital cancelled should be debited. The equity share capital fresh issued will be credited. Originally 1000 but new share offered only 500 for the 1000 rupees. Difference will be my gain named as CR. This can be used for writing of the final loss, profit and loss account. So CR account debit to P&L account. The value being 500. After this, if you prepare new balance sheet, the new balance sheet will have this values. Always cross verify by preparing the capital reduction account. Of course, not required, but it is better to prepare the capital reduction as a working note, because if there is any balance in the capital reduction, no more required, can be transferable to the capital reserve account or can be adjusted in some other assets value. So here, two non-current assets and current assets 50-50. Here non-current liabilities, current liabilities 50-50. Here equity share capital 500. Here P&L account 500. Got tallied. Clear? So with that, question number 1 is over. Shall I move on to the next question? Now, question number 2. In question number 2, yeah, of course, again weak company. Always remember, if you are master here, you can score around 10 to 15 marks in your examination. But if you go for the practical life, always verify will you get the fees or not. It's a weak company, no. After doing all these things, if you don't get fees, then why do you want to work? Be careful here, right? The following scheme of reorganization or sanction. Non-current asset is to be written down by 33.3% or 1/3 is going to be written off. Then 1/3, 5 lakhs will be cancelled. Hereafter, you get 10 lakhs. This is capital reduction. This is capital reduction. Okay, writing down is the loss, so I put the value in brackets. It's a working note like. Current assets are to be revalued at 27 lakhs. 35, now today's value is 27. You lost how much? 8 lakhs. You lost around 8 lakhs. Preference shareholders decide to forego their right to arrears of dividend, which are in arrear for 3 years. Preference shareholders, for them we have to pay the dividend, but it remains arrear for 3 years. So 3 years, 13%. 13,000 per year for 3 years, 39,000 a year. But I have not shown anywhere. As I have not shown anywhere, preference shareholders say you no need to pay. You no need to pay. Already thought it is not required to be payable. Not shown anywhere, not required to be payable. So you just forget about that. You no need to pass any entry. Is that okay? C. In note, especially arrear of dividend or interest and all. This will be applicable not only for the preference dividend, it may be applicable for the interest and debenture and all. Appears in balance sheet, may be wide off fully or partially. Already there is an arrear. If it shows, the balance sheet shows arrear dividend in the liability side. If the preference shareholder says don't pay, then the liability is decreasing gain for us. But appears below the balance sheet, doesn't appear in the balance sheet. Below the balance sheet, there is a note form. It means already not considered as a liability. Not considered as a liability. And then the preference shareholders, the debenture holder says no need to pay. No entry. Appears below the balance sheet, but later on waived completely. Waived. No need to pay. I already guessed that I am not going to pay. You told me don't pay, so forget about that. Just similar to the money you borrowed from your dad. Will you pay back? So the same happens. Dad says keep this as a liability. Never. I never think my dad being the liability or my dad's money is my liability. Dad is also not liability. Dad's money is also not liability, right? Similarly, I thought I am not going to pay. I am not showing that my liability. Says don't pay. Oh, don't worry about that. Okay, forget it. It's not a liability, but he compels to pay. Then it's an increase of liability, a loss like. So, but payable fully or partially, then it is a capital reductions loss like debit side. So these are the points you have to keep in your mind. Here in this illustration, what happened? 3 years arrear doesn't appear anywhere in the balance sheet, not required to be payable. Forget about that. No entry. No entry here. The taxation liability of the company is settled at 4 lakhs and the same is paid immediately. When it's all about taxation liability, 3 lakhs. 3 lakhs. But we have to make it 4 lakhs and pay it immediately. Because of this reason, 1 lakh is extra you have to pay loss. That should also be payable immediately. The payable can be subtracted from the current assets. Hereafter, I don't have the provision for taxation. It becomes 0. 3 lakhs. When I verified to pay, I came to know it's not 3 lakhs. I have to pay 4 lakhs. That too immediately payable. So, rising the 3 lakhs to 4 lakhs, we have a loss 1 lakh adjusted in the capital reduction. The provision for taxation now 4 lakhs. That provision is immediately paid off by cash. Okay, provision for taxation to bank. That's how it is closed. Clear? And one of the creditors of the company to whom the company owes 25 lakhs and decides to forego 50% of the claim, he is allotted 1 lakh equity shares of rupees 5 each in part satisfaction of the balance of his claim. So this is all about compromising. So how much creditors we have? 39 lakhs current liabilities. 39 lakhs. Out of that, one of the creditors to whom we are liable to pay 25 lakhs. Balance, of course, still remains to be payable. Balance is payable. Is that okay? No doubt. In this 25 lakhs, one of the creditors to whom I am compromising, sir, I don't have the sufficient money to pay off. So he comes for the rescue. He says, sir, I am willing to forego 50%. So 50% he is willing to forego 12.5 lakhs. This is my gain, capital reduction. Capital reduction. Okay, balance, for the balance 12.5 lakhs, I will accept 1 lakh equity share capital. Equity share capital, I will accept equity share capital for 1 lakh. 1 lakh into 5 lakhs. 1 lakh equity shares at the rate of rupees 5, so 5 lakhs. So what about the remaining 7.5 lakhs? Balance payable to that creditor. Together with these two, how much still we have the balance here? 21.5 lakhs. Is that clear? The payable balance being 25 lakhs here. Clear? And the rate of interest on debenture is increased to 11%. The debenture holders surrendered their debentures of rupees 25 each. So it is also one more compromise. 8% debentures becomes 11% debenture. For every 100 rupees, they have surrendered 25 rupees. Usually nothing stated means the debenture and preference share capital will have the face value being 100. Out of 100, 25 surrendered. It means 3 lakhs, 1/4 75,000 may be surrendered. It's gain for me. It's gain for me. Hereafter, the new current liabilities being, means non-current liabilities being 2.25 lakhs. But now the value being 11%. The rate of interest being 11%. Is that okay? Then the existing equity shares and preference shares are to be reduced to 5 and 75 each. So this is now 5 rupees. This is now 75 rupees. Automatically what happens out of 3.5 lakhs, 7 lakhs, 3.5 lakhs is my gain, new value being 3.5 lakhs. Similarly, preference shares, new value being 0.75 lakhs, they have foregone 0.25 lakhs. 0.25 lakhs. This is also gain. This is also gain, right? 0.75 lakhs. Okay. Now let me pass the journal entry one after one. Okay, one after one. This should be first written off completely. 3 lakhs is my loss. Creditors, what happens? Here, this one. The mode of compromising with the creditors being this one. Okay. What is the new balance of current liabilities? 21.5 lakhs is payable. 21.5 lakhs. How much is my gain? 12.5 lakhs is my gain. Instead of that, we have issued another 3.5 lakhs equity share capital. Is that okay? So that 39 lakhs is scored out. Okay, come on. Cross verify whether the balance sheet is tallying or not. Okay. Clear? Now we have to pass the entry. I think 33 lakhs. Is it tallying? It's tallying, right? So we have completed, but we have to pass the journal entry to score a good mark, right? Now let's see. Entry number 1 is all about this one for non-current assets. These two are loss. Loss should be debited to the CR account. So CR account debit to non-current assets to current assets. This value being 5 lakhs, 8 lakhs, 13 lakhs. 13 lakhs. Then for taxation, second entry. Okay. Provision for taxation. Account debit, originally 3 lakhs. And capital reduction, 1 lakh. We lose 1 lakh and this amount is immediately paid. Usually the cash may be a part of current asset. So I name this being the current asset itself, 4 lakhs. 4 lakhs. Is that clear? Now, current liabilities. Third scenario. Current liabilities. Out of 25 lakhs, what are the things we get? We gain around 12.5 lakhs. Not only that, we offer equity share capital rupees 5 lakhs. So 17.5 lakhs worth the current liabilities has disappeared. Out of 39, 17.5 has gone. So balance being 21.5 lakhs. Third entry. Fourth entry is all about debentures. Compromising. 8% debentures cancelled. Instead of that, we now offer 11% debentures. 8% debentures being 3 lakhs, 11% debenture being 2.25 lakhs. Difference between these two is my gain, 0.75 lakhs. Then equity share capital and preference share capital. 10 rupees equity share capital, debit 7 lakhs. For them, we offered 5 rupees equity share capital, 3.5 lakhs. And difference between these two is my gain, capital reduction, 3.5 lakhs. We'll go for the preference shares here. 100 rupees preference share capital account debit, value being 1 lakh. And instead of that, now we offer them 75 rupees preference share capital, 0.75 lakhs. Due to which we gain 0.25 lakhs. And we have to write off the accumulated losses here. CR account debit, capital reduction account debit to profit and loss. This value being 3 lakhs. Always cross verify whether the capital reduction account tallies or not. As you told me the balance is equal, definitely it should be tallying. There will not be any balance. Anyhow, cross verify this capital reduction. Here, two non-current assets, current assets. These are loss, right? Loss, non-current assets and current assets, 5 lakhs and 8 lakhs. Here, provision for taxation and current ratio. What's that? This one, okay. To provision for taxation loss, the value being 1 lakh. Here, current liability, this one is loss only, no? Okay, yeah, loss, provision for taxation, 1 lakh. And this one, current liability, they have foregone almost 12.5 lakhs. 8% debenture, they have offered 75,000 discount. And equity share capital, they offered 3.5 lakhs discount. And preference shareholders, they offered 25,000 discount. Finally, loss we have 3 lakhs to be adjusted. Come on, total this 17 lakhs. It's now agreed. Clear?